What's up, guys? Welcome to today's tutorial, which I must say isn't just another trade tutorial or analysis. This is, I think, and this is simply my opinion here, this is, I think, something far more specific and insightful. Think of it as a deep dive into the complex choreography of market structure breaks and supply side shifts. Now, it's a well-known fact that patterns are the secret language of the markets, whispering tales of potential profits to those who know how to listen. When the market breaks structure or formation, it is the same concept, as exemplified actually by the price action in this chart. So when the market breaks formation, it is not chaos, it's a pattern. And patterns, if read correctly, obviously, can create high probability trading opportunities. Moreover, when supply or demand dynamics shift, they create ripples that savvy traders can exploit to anticipate the market's next move. In essence, this trade tutorial offers, in my view, an opportunity to grasp the complex and at the same time a unique interplay of market structures and the dynamic nature of supply and demand zones. When these two fundamental trading patterns materialize, the potential for a highly successful trade amplifies significantly. In fact, I will only consider increasing the number of my contracts when this combination presents itself. And guys, by the time you finish watching this video, I hope you'll have a good understanding of how this high probability trading strategy, which again is my favorite, significantly influences price movements, thereby potentially improving your trading choices. All right, let's now jump right into the chart and get started. Now, looking at this section of the chart, it is clear that buyers or the demand side has taken control, driving the price way higher from its previously low impact trading range. And then this is followed obviously by a sustained rally with any dips during this phase being unpronounced and short-lived. The market then enters a phase where the ongoing consolidation period is coming to an end, marked by a distinct bearish tone. The consolidation phase, for those of you who are new to day trading, is basically a period where the market slows down with prices moving sideways as they attempt to find a balance between buyers and sellers. The bearish tone here clearly signifies that sellers are gaining the upper hand, pushing prices lower. The key indicator, though, of this bearish tone or bearish trend tendencies comes from the formation of what price action traders term as a stop hunt zone located higher on the chart. Now, as you already know, a stop hunt is a strategic area where market makers or large institutions might push the price temporarily higher to trigger the stop loss orders placed by retail traders before the price actually moves in the opposite direction. In this case, the formation of this stop hunt area suggests that there may have been an intentional move by smart money in the market to drive prices upwards briefly, hitting the stop losses placed by the retail crowd before allowing the bearish trend to resume. This is a significant clue, I think, signaling to us that the bears are indeed in control, and we might anticipate a continued downward trend for the time being. And as you can see in the chart, the market dips sharply after retracing this level up here, printing in the process another lower high. With the market's new bias, demand weakens and supply strengthens as deep pockets absorb more liquidity. Now, the degree to which this level over here that signifies the market structural break is breached or remains intact allows you as a trader not only to assess the balance of supply and demand and determine the price direction, but more importantly, confirms whether this level truly represents a significant break or shift in market formation or market structure. If you are correct in your analysis, what should follow is a steady dominance of sellers over buyers. This trend will be further validated, as demonstrated in the chart, by an additional market structure break. You'll also notice that following a ranging period, this sudden impulsive supply bar that leads the price in a second consecutive break of the market structure and subsequent price deterioration concurrently establishes a supply zone, which in my view is undoubtedly a crucial factor in this strategy. Furthermore, I would like to draw your attention to the manner in which the price breaks through the zone's base and trades right through it. To make the long story short, guys, whenever you come across these pattern formations, following obviously the sequence I just described, and here I highly recommend you taking notes, as this trading model offers, in my view, the highest probability of success. So whenever you come across these pattern formations, it is important to know that the optimal entry point is on the short side of the market, after the price, once it enters the supply zone, breaks the previous candle's low on its downward trajectory. It is recommended to position a stop loss just above this point to manage risk effectively. And as you can see from the chart, after this return to the supply zone, the market experiences a dramatic nosedive. The profit targets should ideally be set around these levels without necessarily requiring the absolute low of this range. It is important to establish price targets that are logically sound and provide a realistic price objective. I think that this strategy, as mentioned earlier in this video, not only enhances your understanding of the complex interplay among market structures and the ever-changing dynamics of supply and demand, but also equips you as a trader with a strategic insight to make well-informed entries. It is worth mentioning that the same trading model can also be applied to take long positions in the market using the interplay between structural breaks and demand zones. This is why you need to watch this next video, as I have incorporated all the tips and techniques discussed in this video. Alright gang, thanks for watching, see you in the next one.